Forex Focus brought to you by IG. Going to be a really interesting one here today, more on the, risk management level of how to hedge US dollar exposure. And first, I wanted to highlight the recent price action in US dollar, why it might be an interesting time to do some hedging for this major currency. But then also take a look at what hedging might look like from a trading standpoint, from an investment portfolio standpoint, or from just an everyday consumer who's got US dollars in their pocket, why you might look into it not only now, but also just relative to your situation, as US dollar affects almost everything. Obviously, if you're in the US, you've got a bunch of US dollar exposure as you get paid in US dollars there, and everything that you need to buy for your home is in US dollars. Everything that's in your investment portfolio priced in US dollars. And if you're trading, especially if you're trading gold, crude oil, these different markets priced in US dollars as well, you've got a fair amount of US dollar exposure, which usually isn't that big of a deal. But USD down 10% from its 2022 highs here, and down more than 3% in just the last week. And we're just looking at the US dollar ETF before we get into some more specific relationships here in a second. As the pound is back to above 130, the euro back well above 110, and US dollar against Swiss franc is down to lows for the last multiple years here. And you look at this chart, and there could be even more room to go here. Go back to the start of 2022, and the pound was even stronger against the dollar. The euro was even stronger against the dollar. So might be an interesting time to hedge as that dollar picks up some speed. And I just want to take a look at what the US dollar component of different assets or different investments or different trades might look like. And here we have crude oil, and in black you have crude oil priced in US dollars. In red you have crude oil priced in euros. And just in the last week, my friends, crude oil is up $4.35 in euro terms. It's under $2 there. 3% of crude oil's rally in the last week is purely from its price in USD. And so what does that mean from the everyday consumer standpoint? Well, the price of gasoline, crude oil, these different energy products in US dollar is appreciating relative to if you had hedged off that US dollar exposure in euros and pounds and other currencies. So that hurts a little bit from the consumer level. But also, if you're short crude oil or you're long crude oil, whatever your exposure is to that market, the US dollar part of it, usually stable, usually not so volatile as it's been recently, is really shifting your positions and your P&L around. And to further highlight this point, take a look at gold in the last week here. Gold in US dollar terms is up almost $50, and it's actually down if gold is priced in euro here, moving in opposite directions, just letting you know how big that US dollar component, that US dollar exposure in your portfolio currently looms. And given this volatility, usually we see volatility cluster historically, whereby, big moves, big weeks beget big moves in big weeks. We could see some even further volatility in the gold market, in the crude oil market, whatever you may be trading. If it's priced in US dollar, that US dollar component can either continue to drive those prices higher or take away a lot of these gains. I still can't believe it. Looking at that black line there, gold priced in USD, climbing from about 1920, 1915, whatever you want to call it, in the last week to close to 1965, 1970 on the back of this US dollar. Whereas if you're trading gold in the Eurozone right now, actually moving lower in the same time period, just goes to show how big this component can be. Now, how might you look at transferring this exposure, hedging this exposure? Well, forex markets can allow this to be a relatively small effect on your capital, as there's the Euro USD market currently has a margin rate of around 2%. And other markets can have 3, 4, 5%. It can get high for those more volatile currencies, but for most major pairs, it's between 2 and 5 or 6% margin. And there's greater flexibility. You can utilize small lot sizes. There's one lot that's depending on the quote currency, about $100,000 worth of exposure. You could do 1/10 of that, which is $10,000. You can do 1/100th of that lot size, $1,000 worth of exposure, and get really small, but also particular to the amount of exposure you want to hedge. But it must be stated that with that higher leverage there, especially, there is risk to hedging, right? Like if I'm long a bunch of stock and then I sell a bunch of calls against it as a hedge, I can lose on those short calls, right? I mean, that's effectively, if you hedge a position, you kind of want that hedge to lose. It's particular to your situation, but that is to say that if you have a bunch of US dollar exposure in your portfolio and you want to hedge it, you're worried about this US dollar moving lower, and you want to go in and buy some euro and transfer that USD to euro, there is obvious risk of that euro market moving lower and your hedge hurting you relative to the rest of your portfolio, especially at just a 2% margin requirement. So got to state that risk there. And a couple of other things to look at when you're hedging. Do not overhedge. It can be as simple as calculating how much US dollar exposure you have in your portfolio. So going through your stocks and futures and adding up the amount of money that you have in assets priced in US dollar, and let's say it's $10,000, and say you're worried about this US dollar moving lower, but you're not that worried. You only want to hedge 20% of it or so. Then you want to effectively hedge $2,000 worth of US dollar exposure. But also take a look at diversifying that exposure. As with anything, when you go to buy stocks or commodities or trade any market, diversification is always hit upon as, instead of just buying one stock with all your money, looking at buying 2, 3, 4 stocks, or the S&P 500 basket of stocks to diversify that exposure. Similar with your hedges in USD, and thankfully you can chop that up if you wanted to have $2,000 worth of US dollar hedge. Instead of just buying $2,000 worth of Euro USD, you could buy $500 of Euro USD, 500 of pound dollar, and so on and so forth, and diversify that exposure as well, creating a little bit of a dollar basket for the hedge. And then finally, again, have to note that hedging does also pose risk. It's a new position here, and if you are worried about that dollar moving lower, you want to hedge your cash exposure, or you want to hedge your investments or trading, and that those things appreciate, but the US dollar part of it does actually move higher and hurts your hedge here. The hedge obviously can produce losses, and it's worth noting. So a couple of things to be aware of when hedging US dollar exposure. And everything that I just walked through, of course, is an example. There's no right or wrong answer. It's a percentage of hedge you want to do there, but just picked 20% in the Euro USD market and these other markets as examples. You're going to want to figure out for yourself how you want to do so, but always an interesting exercise to look at how much US dollar exposure some of these markets like crude oil and gold and everything else have. But thankfully here in 2023, relatively easy to move forward and hedge some of that exposure if you're worried about this US dollar moving even lower than it has this year to date.